Hello, everyone. Today, I'm going to be talking about three main reasons why real estate outperforms stocks. Let's get started. Welcome, everyone. Today, we're going to be talking about why real estate outperforms stocks. And I'll be giving you three reasons as to why that is. And if you stick around to the end, I'll give you the fourth one that's a really big player in the overall picture as to why real estate outperforms stocks. Before we get started, make sure to subscribe, as all my subscribers get access to off-market deals, they get invites to exclusive events, and they get a number of reports and other content that others do not. So be sure to subscribe. All right, so let's get started. Real estate's an interesting puzzle, if you will. I get the question all the time, Tom, why would I invest in real estate? The stock market, has done fantastic. I can put my money in stocks, not have to worry about tenants or any of that. Why wouldn't I just do that? Great question. So here's the deal, right? The stock market can have fantastic years. In fact, if you look across, history, it tends to, be between 9 to 11% annually. However, there have been years in the past where those have been 0%. Last year was a fantastic year, and so we have years of 0, up to 20, 30%. Pretty volatile. So the first thing I'll say is, yes, I've never rolled out stocks as a way to wealth. In fact, it's a way that I personally invest, but it's not the majority as to how I invest, okay? You can expect, again, a 10, 11% return on your money with stocks, but there's a lot of volatility, as we all know. So when you look at real estate, okay, there's a few things that matter. And there's three pieces to the puzzle that drives the overall return of real estate. The first one is simply just cash flow. Okay, this is the rent minus the operating expenses minus your mortgage payment, and then the remainder goes to your pocket. That's known as cash flow. If you're working with my team, typically we're seeing deals in the market, in the best of classes, getting around a 6 to 8% return on your money from a cash flow standpoint, to between a 9 to 12% return on your money from a cash flow standpoint. So from a strictly just cash flow standpoint, if you just take that in real estate, you're pretty close to the stock market. But that's not all that is included in real estate. So number two comes in the form of what is called equity paydown. This is a really great vehicle. For example, I have a property in Indianapolis that I've had for many years now, and the same tenant, and they have consistently paid the rent and thereby paying down my loan for me. Okay, and the more that they pay it down, the more principal I accumulate from them paying it down. That's called equity and equity pay down, right? So that's another big component of the overall equation. Now, you can expect, obviously, the equity pay down gets bigger and bigger over time because you're paying less and less interest, but it is a substantial amount of the return. All right, number three is an interesting one. Now, if you look at real estate over the course of our entire history of the United States of America, the average appreciation rate annually is above 4%. Okay, that's substantial. And now I think it's a market to market situation. It's not going to be every market. Sometimes, such as the Bay Area of California, it had substantial 15, 20% years where it fluctuated. This year is probably going to have a correction of 5, 10%, kind of volatile, right? But other markets, solid, stable markets with good fundamentals, tend to appreciate 4 to 6% annually, right? You look at Austin, Texas, where I'm at, I think that's going to be, forecasted to appreciate and probably appreciate between 5 to 8% from the year 2020 to 2025. That's substantial. And I think there's a lot of markets like that, around Atlanta, around Nashville, outside of Tennessee. There's a lot of markets that's occurring. So my point is, that's another piece to the equation that should be included in your overall return on your money. So when you take those three, okay, it's known as your AAR, average annual return, right? You got to add up your cash flow. You got to add up the appreciation. You got to add up the equity pay down. Now, when you do this, the overall benefit or ROI usually ranges between 20 to 25% annually. And here's the thing. In the last 40 years, we've only had one time where the real estate market substantially reduced in value back in 2008. That's not usual. Real estate tends to go up with a little dips here and there, but generally speaking, it's much less volatile than the stock market. Okay, so another benefit. Now, the fourth one for all of you that stayed around is something called bonus depreciation. Now, it's a little more complex, so stay with me here. If you are a single worker, let's say you have a W-2, or and even better if you have your own business, right? But let's say that you work a W-2 job and you have a partner, whether it be a husband or a wife or whatever, that doesn't work. If you claim them as a real estate professional, right, and that means they have to be doing real estate work for about 750 hours per year, and that can be property management and a variety of things, they can take losses from their real estate activity and apply those losses to your ordinary income. As a W-2 worker, what you make is ordinary income. All right. If you don't have that ability to have a partner to do that, or if you don't have your own business, if you're just a single W-2 worker, you have ordinary income, and real estate's a passive income. So you can only take losses against the income of your real estate. Well, if you have something called bonus depreciation, so let's say you buy a $500,000 building and you're able to depreciate that all up front, you can have substantial losses on paper that can write off most of your income. And that can result in huge tax returns at the end of the year. So bonus depreciation, if you have a way to leverage that, and by all means talk to your tax accountant, that can drive up your ROIs substantially. And there's no asset that will compare when you have that bonus depreciation in the game. So at the end of the day, regardless, even the first three variables are still going to net you a 20 to 25% AAR at the end of the day. Hard to find other assets that can do that with that little volatility. So in my opinion, real estate outperforms stocks all day long. So if you want to see more, we got more videos. You'll see it above with the links. Again, be sure to subscribe for more content, and any questions, you know where to reach me, tom@betterturnkey.com. Thanks, everyone.